So after a massive collapse that just wiped out millions of tokens, a totally new kind of crypto project isn't just surviving, it's thriving. And their secret? Well, it's something almost radically simple: real revenue. So what does that actually mean, and why is it changing the entire game? Let's break it all down.
To really get where we are now, you have to understand the sheer scale of the chaos that came before. In the year 2025 alone, 11.6 million crypto tokens died. They went to zero, became totally inactive, they just vanished. This wasn't some minor market correction, this was basically an extinction-level event for crypto.
And this chart right here really puts the explosion into perspective. Just look at that bar for 2025. Back in 2021, a few thousand projects failed. By 2024, it was over 1 million. But 2025? That is just a whole different league. It accounts for over 86% of all crypto failures in this 5-year window. So what on earth happened?
Well, this wasn't some random accident or a market downturn. It was a systemic purge, a great clearing out of all the projects that had absolutely no real economic foundation, all the speculative fluff that had been building up for years. It all started back in 2024, when platforms like Pump.Fun made launching a new token as easy as making a social media post. And that, of course, flooded the market with millions of super low-effort meme coins. So when the market started getting rocky in 2025, that whole house of cards began to wobble. And the breaking point? October 10th, the liquidation cascade, the biggest single-day deleveraging event in crypto history. Billions in borrowed money just gone. And in the aftermath, over 7.7 million tokens were wiped out in that final quarter alone. But here's the thing, out of all that chaos, the market reacted, and it reacted decisively. Investors, builders, everyone started this massive flight to quality. They started looking for projects that were actually built to last, projects that had a real business model. And this quote just captures the new reality perfectly. It's like the market matured overnight. All the old ways of measuring success, hype, narrative, community vibes, they were replaced by the cold, hard logic of revenue and actual cash flow. So this brings us to what we're calling the real yield playbook. It's basically the set of strategies that all these surviving projects are using. It's a series of mechanisms designed to turn a protocol's success directly into real value for the people who hold its token. Okay, so what are these mechanisms really? How does a project actually share its success with the people who believe in it enough to own its token? Let's get into it. There are really 3 main strategies that have become the new gold standard: the fee switch, token buybacks, and direct profit distribution. And I know they sound a little technical, but the concepts behind them are actually pretty simple. Okay, first up is the fee switch. Imagine a protocol is like a business earning fees from its customers. The fee switch is literally them flipping a switch to redirect a percentage of those fees. Now, that money can go to 2 places. It can be used to buy its own token off the market and then destroy it. That's what Uniswap does to reduce supply. Or it can be paid out directly to people who are staking the token, which is the model Athena uses. Either way, it creates this direct link between how much the protocol is used and how valuable the token becomes. Next, we've got the token buyback and burn. Now, this is a classic move from the traditional stock market, and it works exactly how it sounds. The protocol uses its profits to buy its own token from anyone selling on the open market. Then it often burns those tokens, sending them to an address nobody can ever access again. Protocols like Hyperliquid and Maple Finance do this to create constant buying pressure and make every remaining token just a little bit more scarce and valuable. And finally, we've got the most straightforward method of them all: direct profit distribution. This is basically a crypto dividend. The protocol just takes a slice of its revenue and hands it directly over to the people who hold and stake its token. Jupiter on Solana is a perfect example of this. They distribute a huge chunk of their fee revenue right back to JUP stakers. All right, so theory is great, but let's look at the actual titans of this new era and the incredible numbers they're putting on the board. This is where that real yield playbook really comes to life. And the scale here is just staggering. Look at these numbers. In just 6 months, Hyperliquid generated around $326 million in revenue and then used 100% of it to buy back its token. Jupiter pulled in $60 million and sent almost 88% of that back to its holders. And Maple Finance, a leader in on-chain lending, earned over $50 million and uses a quarter of that for buybacks. These aren't vague promises on a roadmap. This is real, sustainable cash flow. So here's the really crucial point. This isn't just some minor trend. This is a fundamental rewiring of the entire digital asset market. It completely changes how we measure success and what we decide is valuable.
I mean, the contrast couldn't be more clear. The old way was all about valuing projects on hype and attention. It was often propped up by just printing more and more tokens, which of course just diluted everyone's holdings. The new way? It's all about tangible cash flow. The fuel isn't inflation anymore, it's deflation from token burns and direct revenue sharing. It's about building a real sustainable economy.
And that brings us to the single most important metric for 2026, earnings. The formula is so simple. You just take the protocol's total revenue and you subtract the cost of any of those inflationary token rewards it's paying out. Whatever's left is the real, honest-to-goodness profit. This is the ultimate filter that separates an actual business from a project that's just paying people to show up. So what does all of this mean for the market as a whole? Well, for the first time, it really aligns the interests of the people building the thing with the people holding the token. More usage means more revenue, which directly boosts the token's value. That creates this powerful flywheel effect. And it creates a resilient model that, crucially, offers the kind of clear, sustainable yield-bearing assets that big institutional money has been waiting for.
Look, the Great Purge of 2025 was painful, for sure, but it was also a necessary reset. It proved that without a real economic engine, hype just doesn't last. So the defining question for everyone in this space in 2026 isn't about chasing narratives anymore. It's about asking one simple, powerful question: does it earn?
So, we've talked about buybacks, fee switches, and direct profit sharing. I'm really curious, which of these models do you think is the most powerful and sustainable for the long run? Let me know what you think down in the comments.
And that's our look at the rise of revenue-generating crypto. If you want to stay on top of the key trends that are shaping our world, make sure you're subscribed. Thanks for tuning in.